The meeting will be called to order. The chairman is on his way. He has asked me to gavel in and begin my opening statement, and then hopefully he will be here. We are very, very honored to have Chairman Powell. We thank him so much for testifying today. I look forward to hearing your perspective on the current state of the economy and the potential challenges ahead. I'd also like to thank you for your thoughtfulness as you help steer the economy through what in some ways are extremely challenging times. As you have said in your testimony, by some measures, our economy is strong. The national unemployment rate fell from 10% at its peak during the Great Recession to only 4.7% when President Trump took office, and it has continued to fall. It now stands at only 3.6%. The economy has continued to add jobs now for 109 consecutive months, more than 9 years. Inflation remains low, below the Fed's target. Wages are moving up, though not as fast as we would like. But it is weak in other ways. But other measures tell a very different story. GDP growth has slowed, falling below 2% in the third quarter. Job growth is also slowing. In fact, it has lagged behind the last years of the Obama administration. About 35,000 fewer jobs have been added per month during the first 33 months of Trump than the last 33 months of Obama. Manufacturing is in recession. Business investments have been shrinking for the past 2 quarters, and productivity fell last quarter for the first time since 2015. Some of these more troubling developments may be a sign of a possible end to our decade-long economic expansion or a slow fade from the sugar high of the 2017 tax cuts. But the most likely cause of economic uncertainty is the president's trade war. This leads to a fundamental question. How should the Federal Reserve act when one of the major challenges facing our economy is the erratic behavior of our president? So I won't ask you to answer that question, but it's on everyone's mind. You have an extremely difficult job, and not everyone has benefited from this economy. In past months, you have conducted a Federal Reserve listening tour called Fed Listens, and I want to thank you for taking the time to hear from Americans from all walks of life who experience our economy very differently. As you know, the economy as a whole can be very strong, while entire segments of the U.S. population struggle. Some regions still have not recovered from the Great Recession. Not all democratic groups have shared equally in the economic growth of the past decade. As members of Congress, we need to serve all Americans. You have shown that this is your concern too. It used to be that a rising tide lifts all boats, but that has become less true, and we know that the tide lifts some boats much more than others. That's why I have introduced legislation that would give us insight into whom the economy is working for. My bill, with a lot of my colleagues, the Measuring Real Income Growth Act, would require the Bureau of Economic Analysis to report GDP growth by income and the top 1% alongside the top line number. It would tell us who is benefiting from economic growth. And that takes me back to the fundamental question before Fed policymakers. How low should unemployment go? How does the Fed weigh the benefits of very low unemployment versus the risks of inflation? We've had 11 straight quarters of an unemployment rate below what CBO tells us is the so-called natural rate of unemployment. Yet inflation remains comfortably below the Fed target rate, which raises the question, has the traditional relationship between unemployment and inflation weakened? If it has, then why? Is it downward price pressure from around the globe? or increased market concentration in certain industries in the United States, eroding worker bargaining power? Or are there other factors in play? And what if unemployment is extremely low, suggesting that we are at full employment, but the unemployment rate for African Americans or Latinos remains much higher? What if the unemployment rate for people in some communities or those who work in some occupations is stubbornly low? These are questions with wide-ranging implications for both fiscal and monetary policy. I look forward to your testimony, and I yield back, and our chairman is here. Great. Welcome.
Thank you very much for being here, Chairman Powell, and I appreciate your patience with our schedule. Votes in committee and on the floor are often difficult to predict. But welcome to the Joint Economic Committee's annual hearing with the chair of the Federal Reserve's Board of Governors. Chairman Powell, I'd like to extend you a warm welcome. I look forward to our discussion today. Our economy has finally recovered from the financial crisis of 2008. Unemployment has reached a 50-year low of 3.5%. It reached that in September and most recently stood at 3.6%. The share of working-age adults with a job has returned mercifully to pre-crisis levels. However, despite this welcome return to normalcy within our economy, and in terms of employment measures, many aspects of our economy remain unusual, and particularly so for central bankers. Inflation remains persistently low. In 4 of the past 5 quarters, inflation has been below the Federal Reserve's 2% target. Treasury yields also remain low, with a 10-year borrowing rate of just 1.9%. Interest rates that were once considered extraordinarily low have become a long-run expectation. These phenomena of low inflation and low long-term interest rates are not unique to the United States, but rather they're echoed in most of the developed markets around the world today. This moment brings with it some challenges, such as building a framework for fighting recessions in a low interest rate environment. However, it also brings some significant opportunities. With inflation still in check, we may have yet room to expand employment even further. As ever, it'll be important for the Federal Reserve Board to communicate how it addresses these challenges and these opportunities. In this regard, the greater transparency demonstrated by the Federal Reserve during your chairmanship, Mr. Chairman, is to be commended. In particular, the Fed has conducted a number of Fed Listens events around the country, including an historic conference held in June to hear feedback on current policy conduct, as well as to better understand the effects of monetary policy at the local level. Not only will these initiatives promote trust in the Federal Reserve and in its decision-making, they'll provide important information relevant to monetary policy from Americans who do not always get a seat at that table, and in the past haven't been able to understand how these things operate as well as they are able to today. I'll now introduce our witness. Mr. Powell is the 16th and current chairman of the Board of Governors of the Federal Reserve System, serving in that role since 2018. He first joined the Board of Governors in 2012. Prior to his appointment to the board, Mr. Powell was a visiting scholar at the Bipartisan Policy Center, where he focused on federal and state fiscal issues. Mr. Powell previously served as an assistant secretary and as undersecretary of the Treasury under President George H.W. Bush, with responsibility for policy on financial institutions, the Treasury debt market, and related areas. Prior to joining the administration, he worked as a lawyer and investment banker in New York City. So we thank Chairman Powell for attending today's hearing and look forward to hearing his insights. You're now recognized for your testimony, Mr. Powell.
Thank you, Chairman Lee and Vice Chair Maloney and members of the committee. I appreciate the opportunity to testify before you today. Let me start by saying that my colleagues and I strongly support the goals of maximum employment and price stability that Congress has set for monetary policy. We are committed to providing clear explanations about our policies and our actions. Congress has given us an important degree of independence so that we can effectively pursue our statutory goals based on facts and objective analysis. We appreciate that our independence brings with it an obligation for transparency and accountability. Today, I will discuss the outlook for the economy and for monetary policy. The U.S. economy is now in the 11th year of this expansion, and the baseline outlook remains favorable. Gross domestic product, or GDP, increased at an annual pace of 1.9% in the third quarter of this year, after rising at around a 2.5% rate last year and in the first half of this year. The moderate third quarter reading is partly due to the transitory effect of the UAW strike at General Motors. But it also reflects weakness in business investment, which is being restrained by sluggish growth abroad and by trade developments. These factors have also weighed on exports and manufacturing this year. In contrast, household consumption has continued to rise solidly, supported by a healthy job market, rising incomes, and favorable levels of consumer confidence. And reflecting the decline in mortgage rates since late 2018, residential investment turned up in the third quarter following an extended period of weakness. The unemployment rate was 3.6% in October, near a half-century low. The pace of job gains has eased this year, but remains solid. We had expected some slowing after last year's strong pace. At the same time, participation in the labor force by people in their prime working years has been increasing. Ample job opportunities appear to have encouraged many people to join the workforce and others to remain in it. This is a very welcome development. The improvement in the jobs market in recent years has benefited a wide range of individuals and communities. Indeed, recent wage gains have been strongest for lower-paid workers. People who live and work in low- and middle-income communities tell us, many of them at these Fed Listens events that the Chair and Vice Chair referred to, tell us that